It is now my pleasure to turn today's program over to Bailey Davis. The floor is yours.
Thank you, Dee Tamara. Good afternoon, everyone. Thank you for joining us today. Bailey Davis, Managing Director, Client Portfolio Manager for ClearBridge Investments. And joining me today in a remote location is Evan Bauman, Managing Director, Senior Portfolio Manager, and co-manager of the ClearBridge Aggressive Growth Fund and Multi-Cap Growth Portfolio. Before we get started, on behalf of ClearBridge Investments, let me wish all of you joining us and your loved ones only the very best during these extraordinary times. Please stay safe. Evan, thank you for joining me today. We thought it would be very important to do this call and talk directly with our clients in light of the amazing volatility we have seen in the market so far in 2020. And clearly, Evan, these are extraordinary times. I guess when you think about it, this is really the first planned recession in that it wasn't caused by an asset bubble, bad investments, or inflation, really. So, Evan, just to get started, I think it would be helpful for our listeners if you could give us some thoughts on the big picture coming out of your meetings with the investment teams overall at ClearBridge, and really give us a sense of how is this transition to a remote workplace progressing from your end today.
All right. Thanks, Bales, and good morning, good afternoon, good evening, depending on where everybody is. On behalf of myself and Richie, who I've been partners with for a couple of decades now, I echo what Bailey said. I think, I hope everyone listening is well and safe and healthy, and certainly appreciate the opportunity to speak to everyone during what certainly are, unprecedented times. We've been through other crises together, meaning all of us have been through other crises together, but nothing quite like, no one could say they've been through anything quite like this. I think the first point, to your question and to address is business continuity at ClearBridge and between Richie and myself and how we invest. And frankly, I could say that it's been really extraordinary. It's been unlike the period post 9/11 in 2001 when Richie and I were working together and doing clients with y'all and many of your clients after 9/11, when we were in Richie's basement doing calls on his hardwired phone and passing the receiver back and forth. I think when you think about today, due to preparedness of the ClearBridge team and technology in general, the ability to connect, through video conferencing and Microsoft Teams and Zoom and remote computing access to information and data, we've been able to, over the last couple of months, be as close to business as usual as you can have. And that's in a number of ways. It's myself and Richie communicating as we always do every day, 7 days a week. As many of you who have known us for a long time know that we don't look at this as a 9 to 5, 5-day-a-week job, that we're in constant communication, and that remains true. And that extends to other members of the ClearBridge team. It's Bailey's team of product specialists, the 30 analysts that work at ClearBridge, our wonderful traders, Lisa and Brian, who have also been with us for decades, other portfolio managers. If you've heard other calls over the last few weeks with ClearBridge, we've been doing biweekly conference calls of all the PMs over Zoom, so everybody's in constant communication, and then trying to speak to as many of you in terms of financial advisors and clients all around the world, because we have clients now in all parts of the world, and importantly, speaking to companies. And I think for the first part of the question, as many of you know, ClearBridge as an investment shop has always prided ourselves in being very engaged long-term investors in the companies that we own. We're not traders. We tend to be business owners, and I think the most important thing to frame today's call is that multi-cap and aggressive growth particularly is the epitome of that. I think we've always looked at ourselves as multi-decade long business owners in the companies that we own, and for that reason, we get tremendous corporate access. The first 3 weeks of this crisis, we spent a lot of time speaking to management teams, executives of the companies that we own, just trying to, as you were doing, I think, gauge the business continuity, talk about liquidity, talk about, to the extent that they were able to discuss the impact of what is such an unprecedented global pandemic and global economic crisis. And while, many companies still to this day don't know the ultimate impact to their business or their markets, just being able to touch base with management and see how they were navigating through this unprecedented period, I think is very important. When I started working with Richie, if you don't know, in the mid-'90s, and one of the points he made was that, the way that we want to invest is to own companies that are financially strong, whose position in the marketplace is dominant. And we always use the phrase that if the markets were to shut down, meaning the stock market or the capital markets, for an extended period of time, that their business would be minimally interrupted and that they could emerge from a period like what we're going through now in a stronger competitive and financial position than we went into it. And I think, to frame the discussion today, there's a lot of uncertainty. There's a tremendous amount of uncertainty, both around the health crisis, the economic impact, and the stock market impact. But I think this is, as well as always, it's important to own businesses that are financially strong, where balance sheets are liquid, that generate a lot of cash flow, and the types of industries and markets where your company as a leader can again gain share and emerge from a downturn in a stronger position than it went in. So I know we're going to talk about a lot today, but in terms of the initial question, Bailey, how the transition to a remote workplace has impacted, I think we are in a very strong position and feel very good about how the communication and the continuity remains. And again, a testament to ClearBridge as an entity, Terrence Murphy, our CEO, Scott and Hirsch, our co-CIOs, and the entire team that's assembled there.
Yeah, I concur with that, Evan, and clearly these are crazy times, and unfortunately, there really was no pandemic playbook per se coming into the first quarter of 2020, and you remarked on your times with Richie during the 9/11 crisis, and I was going to ask you, does this particular period remind you of other large drawdown type periods? But considering the moves that we have seen, I think a better question may be, and just seeing what's happening in the markets today, can we see mega cap leadership in the market broadening into other parts, you think?
Yeah, I think so. Taking that, in terms of 9/11 was maybe analogous, but that was more of being a New Yorker, right? I think this is unprecedented in terms of just the impact on a health and human aspect of the virus and the disease and the economic downturn, which is global. So let me take that first and then kind of get into the stock market itself. And as you said, it's been a market that's been led by, for the most part, a few technology mega cap names. But let me just step back for a second and talk about kind of three aspects of this particular pandemic, which is, again, the health and human aspect, which has touched all of us. I think all of us have been touched. Everybody on this call has somebody or knows somebody that's been impacted. And if not, knock wood, directly impacted, certainly our lives have all been impacted by the stay-at-home policies and the fear and the economic downturn that's been caused. And frankly, I think this virus has exposed a lot of weaknesses in terms of preparedness. You never expect the unknown. And using the 9/11 example, this was an external event, but clearly it exposed weakness in preparedness in the supply chain, both in healthcare and technology, critical healthcare components and infrastructure, some of which I think as we get into kind of positioning and outlook, clearly we're going to need to be more prepared in the future for a event that occurs, even if it's unforeseen, to have redundancies and inventories and obviously more infrastructure investment to prevent any type of recurrence of what we're experiencing now. Economically speaking, I think the encouraging thing is the economy was in a very strong position coming into the decline. But I think we also saw the sharpest overnight decline, again, globally, but we'll speak today to the U.S., decline from a very strong economic position to record unemployment and a massive slowdown faster than anybody's seen in their lifetime. The encouraging thing there is obviously the response, both monetarily and fiscally, was immediate, and it was powerful, and I think it prevented a recurrence of, what essentially happened in other sharp declines, which became systemic and became a negative feedback loop, at least in terms of the monetary and fiscal response. We saw stabilization immediately because of, again, a focus immediately on the plumbing in the system, so liquidity and then short-term lending, and then moving over to stabilizing the credit markets and providing support and relief to the most impacted, both on a business basis and an individual basis. So we initially got a very, if you want to call it, shock and awe type response to the economic stoppage that occurred from, we'll call it, the second week in March until the third or fourth week in March, where the drop-off was most significant. The question is going to be the recovery, and I know everybody's trying to predict it. You've heard a lot of experts in the macro side talk about what the recovery is going to look like, how it's what shape it's going to take. As more of an investor and a stock market guy, and also I think someone who follows the science, our sense, Richie and I have a sense that this is going to be a long, slow, drawn-out recovery. I think it's no one knows the shape. Many companies themselves have no visibility on the second half of the year right now. To give guidance would be a guess, and so you've seen a lot of companies actually. Some have given guidance on the second quarter. Many have completely pulled guidance in terms of the second half of the year or the full year because there is a tremendous amount of uncertainty. And our sense is that until you have a vaccine, until you have significant testing, both on the antibody and the serology side, that you're going to have an economy that, while it might be stabilizing, is going to take quite a long time to recover in terms of full potential recovery. Again, there is an old adage, don't fight the Fed, and the Fed has done many things and will continue to do everything in its power to re-stimulate or at least support the economy. But to this point, there's still a tremendous amount of uncertainty, and I would say that to some extent it pays to be relatively cautious or conservative in terms of economic assumptions when you're making investments, which brings me to the stock market, Bales. As you said, there's elements of other crises, other crashes. You can go to the 1987 crash. You can look at the dot-com bubble burst in 2000 when the NASDAQ crashed, the 80+%, the 2008 crisis, which, again, all led to significant stock market contractions and recoveries. I think there are elements of each in this decline, and as you look for hints of what the market will look like going forward, I think there are lessons and there are analogies you could use on each. The encouraging thing, similar to the economy, is the market before the decline, and I'll speak to the portfolio specifically. You were not at extremes. Even though the stock market was at all-time highs, you had really no bubble in the majority of the market. As you said, you clearly had mega cap leadership. You can argue that the indices or even investors in the growth space might have been crowded in fewer names, many of which were the kind of 600 billion and up technology names, but you didn't have any signs of a bubble coming into this decline. Sentiment was actually somewhat cautious all the way up. You had the proverbial wall of worry as the market continued to rally. More folks were nervous, even again, without any line of sight to this health crisis. But I think what we've seen recently, again, is unprecedented. You had the sharpest decline from a peak in a bull market or a peak all-time high in the market to a bear market in history. So you had a 22% decline in a matter of weeks. You had a 35+% decline in the market in about a 3 or 4 week period. And I think that when you look at how unique this period is, you had a lot of stocks across the board that declined 40 to 60%, if not more, in a very short period of time. So you did have similar maybe to the 87 crash, which also was exacerbated by portfolio insurance, not dissimilar to this time around, where you had a number of trend-following vehicles, levered hedge funds that were obviously hit the hardest in the decline. You had elements, including panic selling, that exacerbated the decline. As we look back, and we look back 5 or 6 weeks ago, our sense is that the March 23rd lows were probably the ultimate low, certainly the initial low, probably the ultimate low for the market. You had the most oversold market in history. You had a tremendous amount, again, of deleveraging or forced selling akin to a margin call. And you had obviously a really a panic sell-off that drove the market to its ultimate lows. Everything almost sold off uniformly. Since that period, you've had a pretty good counter-trend snapback rally. You've recovered about half of the losses. Ironically, as you said, Bales, you've sort of gone back to previous leadership, and I'm sure we'll talk about where we think leadership will be for the next 5 or 10 years, and obviously the near term as well. But you haven't had necessarily as much of a broadening out of the market as one might have thought. You had a significant rally. A lot of the big names have rallied back either to or near all-time highs. And generally, when you get this type of visceral, violent sell-off, you get a rally. You get, as we've talked about before, you get some backing and filling. You ultimately generally get a retest of the lows at some period. It happened post-87. It happened post-08. The market didn't ultimately bottom until March of 2009. And then when you get a more durable, sustainable rally off of the lows, historically, you do get different-looking leadership. At least you get a broadening out in terms of the market itself, and very often you get new leadership. And my sense coming out of this decline is it's not going to be dissimilar. I think the market ultimately is going to have some companies that I talked about earlier come out of this stronger. They gain market share, or they're in the right position to take advantage of new behaviors or new ways that business is done. You'll have other companies that I think are going to struggle, and I think coming out of this, it's going to be increasingly and essential that you own the winners, that you own companies that are financially strong, because as we've seen already, I think companies with significant leverage, or those that are predisposed or significantly exposed to economic growth, are going to have a difficult time. Certain industries, certain companies will struggle. Other industries will shrink or cease to exist. And you'll also have an emergence of some new industries, some new innovations, some usually coming out of a crisis like this. Some of the brilliant minds in the U.S. actually are able to create new markets and new opportunities that emerge. So it's only been a couple of months since really this hit the U.S. en masse, and obviously we still have a lot of uncertainty. But I think there's for long-term emerging growth managers like ourselves, for a market that's been dominated by the big names, I think there's tremendous opportunity that's going to emerge from this downturn.
That's great. Clearly, maybe we can shift gears a little bit, Evan, and talk a little bit more specifically about the COVID situation today, and really of all the changes that are occurring to the way we live and work. As we noted earlier, I mean, you and Richie have talked about the amazing innovation, almost a modern-day Manhattan Project occurring in healthcare. So I thought, and this might touch on some of the questions that we're getting right now, but, what themes and are you guys really seeing that you feel have a lot of staying power today?
Yeah, no, I think that's a great question. A great question, Bailey. I mean, so just starting with healthcare, because it's at the front and center of the crisis, and it's also been a key area of investment for the portfolio going back to 1983 when Richie incepted the strategy. And again, I've been with him for more than half that time. But we've always looked at healthcare as an innovative, disruptive area I think what we like about it quite a bit is the exclusivity component. We've always talked about the ability to find unmet need or treatments for unmet need on a global basis. Those companies, again, have a significant first mover advantage. They have patentability. They have exclusivity, many of the things you don't get in other areas of the market that are more commoditized or competitive. But for the last 5 or 6 years, healthcare in general has really been a laggard in the market. And you've had some winners, but I think as a monolith, as a sector, I think you clearly saw rising healthcare costs, drug costs become politicized, and many of the companies in the healthcare space were vilified. They were considered the enemy, as opposed to where we look at this sector as being part of the solution. And I think this crisis will highlight the fact that when you look at the healthcare space, particularly certain subsectors like the innovative biotherapeutics and diagnostics and some areas like analytics within healthcare, what you're going to see is somewhat economically unsensitive or economically defensive area with some of the cheapest valuation in the market, that if this doesn't emerge from this crisis as a leadership group, remember, it's still a very underappreciated area. The index right now, back to the earlier point you made, Bailey, it's 50% tech and internet. It's only about 15% healthcare in the growth index. But if you look at the future and you look at the what's I believe going to become a recurring theme, it's that we can't have a repeat of this event, this crisis that we've had. I talked about lack of preparedness, but it's also, you look at the amount of money that's spent in the healthcare space, a lot of it goes into very late stage patients, it goes into redundant costs, it goes into areas where early stage diagnosis and preventative medicine and predictive medicine, which involves diagnostics, and we've seen a tremendous amount of innovation in the early stage diagnostic space. We've taken some investments there. That is really the way to bring down overall healthcare costs, and it's prevention of disease. I talked earlier about vaccines, but prophylaxis and determining who might be at risk of a disease and then preventing a crisis before we're at the stage that we're at right now, where, again, right now the key is finding therapies. Gilead had an encouraging drug in remdesivir, but there's going to be tremendous innovation that comes out of the therapeutics area as well, with precision therapies, genomics, gene therapy. We own a number of companies that are focused on unmet need, not just in antivirals like this particular crisis, the COVID-19 crisis, but areas like neurology, where Biogen has been a leader in Alzheimer's and other unmet needs like ALS and Alzheimer's, and what Vertex has done in rare disease and particularly in cystic fibrosis. But the reality is the way out of this crisis, I think, again, is it's more testing, it's more analytics, it's a combination of more preventative and better treatment techniques and a lot of testing. And I think the other key element that will come out of this, as I mentioned earlier, is bringing critical components of the supply chain, particularly in healthcare, back to the U.S. We can't rely on foreign countries for exactly the reasons that we've entered into some elements of this crisis. So it's still an area of the market that I think is very underappreciated. I think that, when you look at the amount of spending that I believe has gone into, as you said, with the Manhattan Project, has gone into trying to find an efficacious treatment and vaccine for this disease, but longer term preventing a recurrence will be staggering. And I think that's a tremendous area of opportunity. The other area in terms of, other two areas that we're invested in that I think are poised to benefit, one is media and social media. You talked about, obviously, new behaviors and stay-at-home beneficiaries. I mean, you've seen, especially with no sports being on the air, no Olympics until late next year, you've seen a tremendous increase in ratings for particular programming, especially lifestyle programs, the likes of which Discovery has significant ownership of. You've seen a big shift in advertising from traditional video sources to streaming video on demand, digital advertising, and you've seen record engagement and record ratings for a lot of the programmers. Now, again, that hasn't translated yet into increased ad dollars because obviously ad spend is down significantly, but over the long term, companies like Discovery, AMC, what Twitter is doing, seeing record growth and engagement, and even Comcast, which is the biggest holding that we have, is seeing, again, big ratings increases for their programming, much of which they own the IP. Sports will return, and obviously, our sense is advertising will return sooner rather than later in terms of the economy, but clearly shows the value in sports and sports programming. And when it returns, I think it will return en masse. One of the other interesting dynamics is you will have next year when you have the Summer Olympics and Winter Olympics in very close proximity, you're going to have, I think, a big uptick in advertising and engagement for both the traditional media companies and social media companies. In terms of technology, we talked again about the mega caps dominating, but you clearly have beneficiaries of a more remote workplace. So, we've had an investment in Citrix for a long time, obviously a major beneficiary of the work at home environment. And as they made very clear on their conference call, this is more of a sustainable trend because now you're going to have many companies that will have permanent work from home policies and certainly will have backup plans for the unforeseen events like we've seen. Growth in the cloud, which obviously benefits the big guys, but another major beneficiary there is storage, in which we have a couple of companies there that benefit, and cybersecurity. We've seen a huge uptick in cyber attacks and phishing attacks and malware attacks through downturn, and cybersecurity has become clearly an essential technology for enterprise investment. The need for broadband, I think this benefits companies that we own like Broadcom. It also helps Comcast and some of the storage names. But I think the ability to bring down costs is another key theme that a lot of companies will look for. So broadband for streaming, but any technology company which can help an enterprise bring down costs and increase their free cash flow, I think are major beneficiaries long-term of this event. The other point I'll make before I kick it back to you, Bale, is a lot of the trends that were in place, long-term disruptive trends like electric vehicles, 5G, et cetera, you're going to have continued investment there. And so you might have a bit of a delay, but I think longer term, you look at the increased content in vehicles, connectors, sensors, et cetera, increased technology that goes into automobiles. A lot of these will be key trends for the next 5 to 10 years, even if they're somewhat slower than might have been pre-COVID-19.
Thanks, Evan. Well, you stole my thunder a little bit on the next question because one of the questions that came up was, could we comment on some of the secular themes like 5G, electric vehicles, and the cloud, which you did. One other question that we received on the line is, can we comment on our current energy exposure within the portfolios?
Yeah, I talked a lot about what we like, healthcare, media, technology, some other disruptive areas. I think the reality is I did mention in some of the earlier comments about industries that need to shrink, consolidate. Within the market crash and the COVID crisis, we had a subsequent or coincident energy crisis, energy crash. Energy prices obviously fell to the lowest levels in history. And so, I made the earlier comments that right now you want to focus on cash and cash flow and defensible businesses and companies that can gain market share. I think, we've invested in energy for many, many years. This is probably the lowest exposure that we've had to energy since I've been on the portfolio, which again extends back decades. You're going to have winners. You're going to have a lot of losers in an energy industry that's still very over-levered, that needs to, again, on the supply side. Remember, we had a coincident supply and demand shock in energy, but just looking at the supply side, I believe it's going to be a multi-year compression or contraction in supply, especially, speaking to U.S. companies, many of which are still too leveraged. So we made the point that, that sector becomes very binary. It's kind of high risk, high reward, and there's still no direct path to higher prices in the commodity side other than what you're starting to see now, which is massive shut-ins of rigs and wells. You're going to have to see a major contraction in supply. And then again, on the demand side, there's still a tremendous amount of uncertainty in terms of when real demand starts to come back. Inventories are still too high. Storage is basically full in the U.S. And so that's an area where money can be made, but it's going to be, again, a long, protracted decline before you ultimately see winners. Right now, it's all about survival. So you're looking at, if you're going to invest in energy, it's companies that have balance sheet strength, that have free cash flow, even in these much lower price deck environments. And you're well below the marginal cost of drilling right now. So eventually you will find equilibrium. Eventually you will have another cycle. But my sense is that's still a couple of years off. So, there's just, with the whole market down significantly, I think this is a time where you don't have to take undue risk in an area where the unknowns, I'll say, outweigh the either what or certainly what companies can control. They obviously don't control the price of the commodities, and so right now it's looking in some other areas and using some of the investments there as source of funds to buy some other names.
Okay, great. And I know we're bumping up on the 40-minute mark, so I'll close out with one more question. And clearly turnover during the history of the fund and the separate managed account has been very low, but we typically see some increased activity during these waterfall-like declines in the market. Can you give us an idea, which you did comment a little bit on, but can you give us an idea of some of the actions that you're taking in the portfolio with the incredible amount of volatility that we're seeing in the market? So can we expect to see even more activity occurring? Because as we all know, you and Richie both tend to be long-term investors, lower turnover growth investors.
Yeah, it's twofold. It's the first tranche, for lack of a better word, for us in the first 3 weeks of March was really buying more of what we knew was attractive. So that was buying companies that were actually down, but beneficiaries of some of the themes that we talked about earlier: cybersecurity, diagnostics. It was buying, adding to some of the positions like Twitter and Citrix that were actually standing to potentially benefit from where the future would go, but really focusing on quality and what we knew was cheap. I think one of the points about this strategy, if you have the presentation open, this is a portfolio that was cheap coming into the downturn on a relative risk-reward basis versus history, that at the end of the first quarter, it was a growth portfolio trading at 12.5 times earnings. So, and that's after, the decline and the snapback. So we bought some more of the names that we've owned for a long time that we knew were cheap. Yeah, and Richie and I have been doing a lot of work over the last few weeks in really starting to look at some newer emerging companies. Some of the names, maybe we missed them on the way up, or maybe they've come down now to levels that we find particularly attractive. So it's sort of, this is the next leg. I think we've always had a saying that you want to buy something you know is cheap or something you know is attractive, not something you hope is attractive. Because in my earlier comments, I made the point, you're going to have some companies that see a huge drop-off in their business, and that might not be because of anything they're doing. It's simply that their end client is a small and medium business, or it's a consumer that's not spending other than on essentials. And so we have a laundry list. We have a shopping list, if you want to call it that, right now, of a number of companies. We've had We've had a number of meetings with them over the years. Now the stock prices are at levels we're finding attractive, but it's twofold. It's looking for names that we own that we no longer find to have positive risk reward, and we did sell out of something in energy, some other more commodity sensitive names, more economically sensitive levered companies. And you will see, as you said, if you go in history and you look at the period post '08 and you look at what's going to happen, I think out of this period, there will be some real opportunity to take new investments, to take new positions in some new emerging areas. We did add a diagnostics company that's a leader in early stage cancer detection. We're looking at a number of names in technology in areas like analytics, and I referenced earlier companies that will improve the cost of doing business for some of their customers and their clients. So, yeah, Bales, to your question, there will be increased activity. There's already been quite a bit, but expect over the next few weeks, as I made reference to. I don't think Richie and I's view is the market goes straight back to new highs right now. If it does, that would actually be somewhat concerning, because I think it would be really dislocating from the economic reality. Right now, I think you have to know what you own. I think you're going to get the opportunity as the market has more volatility moving forward to take advantage of that. I referenced earlier, we're in earnings period right now, and unlike some of the names that we own, like UNH and some of the big healthcare names that are actually able to give guidance, a lot of the more economically sensitive areas of the market, companies are pulling guidance. The stocks necessarily haven't reflected that, and we've still been in a market where momentum has really disconnected from value. It's still a very momentum-driven market, and we're much more focused on balance sheet strength, cash flow and valuation, and I think patience is going to prove to be a virtue. You'll get your shot, but you have to be patient and know what you're buying.
Right. And Evan, maybe just real quickly, I failed to touch on it, but clearly the portfolio, as you can see in the slide, is very, very cheap versus the index itself. All-time kind of levels of cheap valuation for the overall strategies. But do you guys foresee more M&A activity occurring? I mean, clearly there's been a history within this strategy of a lot of different takeovers occurring. Are you getting the sense that we'll get a round of M&A happening?
Yeah, it's a great question, Bailey. We've had over 100 companies acquired over 37 years, but you don't seek out. We're not activists. We're not pushing a company to sell itself, and we're not buying for the sole reason that we think a business can be acquired. We're buying cash flows. We're buying cheap valuation. We're buying companies that in the public markets we believe are really disconnected from the intrinsic value of the business. And so if you do that and you're patient and you know what you own and you have a longer-term time horizon, eventually you're going to get a number of companies acquired. And I think the reality is, as I go back to some of my earlier comments around media, we have a series of companies that trade between 3 and 6 times free cash flow with 20 to 25% free cash flow yields. Some of the programmers, some of the names I mentioned earlier that are relatively unlevered, where valuations are incredibly compressed right now because of fears around cord cutting and around new streaming techniques and over-the-top video. Well, there's still value. Ultimately, there is value in the cash flows and the IP and the programs that these businesses own. So, yeah, I think the two areas where I think it's most obvious for either consolidation or the emergence of private equity / LBO activity is media one and parts of healthcare two. If we're right around the growth of the innovative therapeutics and diagnostics companies, in longer term, I think you'll see a big wave of consolidation with some of the larger, big pharmas or conglomerates starting to look at valuations in an area where, when you take a top-down view, Biogen still trades at less than 10 times earnings, just on today's base business earnings. And you have a number of, again, very cheap valued enterprises vis-a-vis both history and the index. The index is comprised of a lot of tech, a lot of internet, and a lot of momentum names, whereas we hope to buy emerging companies that over the years become momentum stocks. And again, just to kind of summarize our philosophy and our process and our discipline that's been in place for almost 40 years, that you want to buy good growth businesses with defensible franchises that cash flow significantly, that either the stock market monetizes over time, or that can be monetized by other companies who see the IP or they see the growth and they want to own it. And I think there's, throughout the portfolio, I think there's a number of names that fit that sort of second, that second point, which is maybe not tomorrow, because obviously right now, in this environment of uncertainty, companies are about preserving balance sheets, preserving capital. But over the next few months, as we emerge from the worst of the downturn, I think you will see a lot of money spent on M&A. And I also think that the private equity, who's really been, for the most part, sitting on their hands through the downturn, it's going to be areas like media where they emerge and they start to see a real economic opportunity to spend some cash. So, yeah, I think there'll be more deals, maybe not tomorrow, maybe not next week, but over the next few months.
Great. Well, Ev, thanks. I think that's all the time that we have, and I want to thank you for all your great color that you provided. Also, I want to give a big thanks to everyone who joined us on this call. We truly do appreciate all of your support and interest in the strategies that we talked about today. And as mentioned earlier, please stay safe during these challenging times. I now need to read a full disclosure, and then we'll end the call. Please note the following: past performance is no guarantee of future results. The opinions and views expressed in today's call are of the individual speakers as of May 7th, 2020, and may differ from other managers or the firm as a whole, and are not intended to be a forecast of future events, a guarantee of future results, or investment advice. Any statistics referenced have been obtained from sources believed to be reliable, but the accuracy and completeness of this information cannot be guaranteed. Neither ClearBridge Investments nor its information providers are responsible for any damages or losses arising from any use of this information.